Emerging markets are often associated with higher perceived risk. Volatility, political developments, and currency movements are part of the landscape. And it's a fair concern. But risk is not uniform. It varies significantly across countries, sectors, and institutions, and can be actively managed through careful structuring, disciplined underwriting, and deep local expertise and close engagement. In private markets, in our experience, diversified portfolios have historically delivered stable and relatively low volatility returns, with limited performance impact during periods of major global market drawdowns over the past 25 years. That resilience is an important feature in portfolio construction. In many of these markets, access to capital remains constrained. From an investment perspective, those financing gaps create specific opportunities. Well-structured investments can offer attractive risk-adjusted return potential, provided risks are carefully assessed and managed. Emerging markets are expected to grow at around 4% per year, compared to roughly 1.5% in developed markets. That differential reflects demographics, productivity gains, and ongoing economic development. Low and middle-income economies account for roughly 80% of the world's population and represent most of the global working-age population, often with younger demographic profiles than advanced economies. Another dimension is innovation. Across many emerging economies, digital transformation and technology adoption are accelerating. As of 2024, around 62% of adults in low and middle-income economies use digital payments, nearly double the share a decade ago. These payments often act as an entry point to financial services and help build credit histories, supporting new economic activity.
We're often asked, why emerging markets? And it's a fair question, especially since the majority of assets managed by BlueOrchard are invested in emerging and frontier markets. We do it because we believe this is where capital can have meaningful, measurable positive impact and where we see compelling long-term financial opportunities. Emerging markets face acute challenges from climate variability to infrastructure gaps and social needs that require financing solutions. That's where impact investing comes in, allocating capital with the intention of generating measurable social and environmental outcomes alongside financial returns. And this is precisely where BlueOrchard has been active for the last 25 years. Private markets play an important role in emerging and frontier economies as access to capital remains constrained. The funds and mandates we manage seek to address these gaps through tailored financing solutions. In many emerging markets, social and environmental challenges are often much more acute. In this context, we really believe that the relative marginal impact of capital can be much higher. Take agriculture as an example. In developed economies, it typically represents less than 2% of GDP and only a small share of employment. By contrast, in many low-income countries, it remains a key part of the economy, accounting for around a quarter of GDP and employing a large share of the workforce, over 40% in some regions. Yet, access to financing for smallholder farmers and agricultural SMEs remains limited despite their central role in food security, rural livelihoods, and economic stability. In this context, targeted financing through agricultural lending or support for climate-resilient practices can make a meaningful difference. Another example is climate finance. In many emerging markets, renewable energy projects replace more carbon-intensive systems as energy mixes are still reliant on fossil fuels. As a result, the marginal climate impact of capital can be significantly higher. But beyond individual sectors, the scale of the broader challenge is substantial. The annual financing gap to achieve the SDGs in developing countries is estimated at around $4 trillion per year. From an impact perspective, this leads to a central question: where can capital generate the greatest measurable outcome?
Another key dimension is diversification. Emerging markets represent a substantial and distinct component of the global investment universe, spanning different regions, currencies, and stages of development. Their macroeconomic cycles and sector exposures are often different from those of developed markets. For long-term investors, this can broaden the opportunity set and reduce reliance on a single economic cycle. At the same time, outcomes vary significantly across countries and issuers. For us, the financial case is closely linked to expertise. It is not about broad exposure, but about careful selection. Disciplined underwriting, detailed credit analysis, and continuous monitoring are essential. In private markets, structuring, covenant protection, and close engagement with counterparties can play a critical role in managing downside risk. Ultimately, emerging markets are not defined only by their challenges, but by their potential. When approached with discipline and a long-term perspective, they offer access to growth, diversification, and resilient return opportunities.
And from an impact perspective, they are where capital can contribute most meaningfully to inclusive growth and economic resilience. And it is precisely this combination, our goal to deliver meaningful positive impact alongside financial discipline, that keeps emerging and frontier markets at the center of our strategy.